Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We've got a familiar face returning to the show. John Roque of 22V Research is going to be joining us today. If you don't know John, he's one of the most respected technicians out there. He's worked at multi-billion-dollar asset managers like Soros Fund Management and Key Square Capital. You might remember we had him on about 6 months ago, and he made some pretty timely market calls then, and he did it again this week shorting regional banks. So we'll definitely be talking to him about that. But before we talk to John, let's take a quick look at how this week played out. All right, so it was a pretty ugly week. All four major indices closed lower. The NASDAQ led, but it still fell nearly 4%. Small caps lagged by a notable margin, with the Russell 2000 dropping 8%. Taking a closer look at the S&P 500, it was the worst week since September. We lost some pretty key levels. We're back below that 200-day moving average, the uptrend line from the October lows, the anchored VWAP from the peak, you name it. So definitely not the most bullish look in the near term. Keep an eye on those December lows next week around 3,800. If we can't hold those lows, there's really no support until the October lows. Now, taking a quick look at the sector performance this week, all 11 sectors closed lower. Defensive sectors like staples and utilities led, but still fell about 2%. Financials were the clear laggard, dropping about 8%. That was a big development this week. Regional banks really took it on the chin on Thursday, but we're going to dive into that a little deeper with our guest. So without further ado, let's welcome John back to the show. John, welcome back to the show, and thank you for joining us on such short notice.
Thanks a lot, Patrick. Always a pleasure to talk to you. Good to be here.
Yeah, well, we've got a lot to unpack here. It was a pretty crazy week. I'm just as confused as everyone else is right now, so I've got a lot of questions for you, and hopefully you can help us make sense of it all.
I hope I don't muddy the waters. Let's go.
Well, we've got to kick it off with the hot topic of the week, which of course was financials and banks more specifically. And you sent out a note to your clients on Tuesday saying short the regional banks. And sure enough, 2 days later, the regional bank ETF KRE had its worst day in about 2 years, I think more than 2 years, down about 8% on record volume on Thursday. And then, on the week overall, it was down like 16%, which you really only see that, kind of weekly action in like COVID, and you got to go back to 2008 and all that. And I got to tell you, this is shaping up to be one of the better market calls I've seen this year. But break down the chart of KRE for us, and what initially did you see on it that kind of had you bearish?
Okay. All right. Thanks. I've always been of the opinion that the market can't go up if the banks go down. Now, the market can go up if the banks don't go up on an absolute basis, but they can't go down on an absolute basis. So I used kind of this analogy where a Princeton, New Jersey high school senior applied to Stanford University, and he wrote his college essay where he hashtagged this item that he was passionate about 100 times. So I figured I was going to hashtag it up the wazoo with respect to the following items. Number one is hashtag the market cannot go up when banks go down. Number two is hashtag bad things happen in bear markets. And number three is hashtag bad things happen in downtrends. And I think, those three things might be on my tombstone, or they might be my epitaph, because that's the way it has always worked. And I expect that that's the way it will work. And so the banks grease the market. They grease the economy. I don't say that pejoratively. And they've been in bad shape for some time. It's just that, we were lulled. All of us were lulled to sleep over the past few months because they kind of had a rally back, but it wasn't really that impressive. And the MACD moved slightly into positive territory on a weekly basis, but it was still burdened by a downward sloping 40-week moving average, which you'll see on the next chart. And so I thought it was a pretty good time to kind of talk about selling, the banks, the KRE, the BKX, et cetera. And I had some conversations as I was thinking about it with investors or clients. And I had said to them, if 3/4 of the PMs still active understood the relationship between the banks and the market, I think the S&P would be a lot lower. And similarly, if they understood the relationship between the banks and the economy, the market would be a lot lower. And then I said, kind of as a coda, there's almost, parentheses, no way the market can rally when banks go down on an absolute basis. And we kind of saw it. But the deterioration had been going on for months. It's kind of like what happened, and I'm not making light of a tragedy, what happened in East Palestine, Ohio. NSC and the rails had been poor for months. And then the East Palestine situation occurs, and then NSC, tumbles. I think that's kind of the way it was for the regional banks. The poor situation had been going on for months, and they just tumbled this week. I happen to get lucky because I sent it out on Tuesday.
That's been kind of a mantra of yours for a while. The market cannot go up if the banks go down. And, you've been saying that as long as I've known you. And, it's not just the regional banks, it's financials more broadly. You have this great chart here showing financial sectors kind of painted with one brush. And even some of the leaders within the group, like broker dealers and stuff, those have come under pressure too. It's really kind of the whole sector more broadly, right?
Correct. And I had heard, even internally over the prior few days, that it's not going to be all the financials that suffer here. And ideally, that's what we would like to happen, but I don't think that's what happens in practice, because so many of these stocks are owned in the same ETFs or in the same mutual funds, and when they're sold en masse. And you could see the degrees of the amplitude of the moves are different, but by and large, the trends are the same. And of course, in teal or in that light green toward the top, that's the investment bank group in the S&P. But otherwise, the curves here are virtually identical.
Yeah, and it seemed like Silicon Valley Bank, that got a lot of buzz for obvious reasons, and it is a concern, but the weakness we saw this week, it wasn't just isolated to that. You look within KRE, there's over 140 components in there, and every single one of them was down on Thursday by more than 1%. So it was pretty broad weakness, and you have this chart of JP Morgan here. And it's, kind of sporting that head and shoulders top. You said it's still above its 40-week moving average, right? So you're giving it a little bit.
I think the market got a reprieve. The market's gotten a reprieve this week in that JP Morgan is still above its upward sloping 40-week moving average or 200-day moving average. That's a reprieve, because JP Morgan, in my mind, and it's the next chart, is the best market bellwether we have. So except for the period of 2004, 2005, where JP Morgan was wrong, it's been otherwise right from the early 90s to date as a bellwether for the market. And the market does not go up when JP Morgan goes down, and this should not be ignored. I know this is kind of the province of, perhaps pocket protector, horn rim glasses, slick back hair, pencil behind the ear, old time traders or technical people or people who kind of learn the craft, kind of passed down via folklore. This might not fit with a quantitative approach, but son of a gun, it fits pretty darn good with respect to passing my eye test. And so if JP Morgan is firm, the market is generally firm. When JP Morgan and the banks are not, then, you kind of really have to pay close attention.
Yeah, I mean, I think the key takeaway here and why I wanted to kind of start with the banks, not only to highlight your great call, but, to really highlight that broader market implications there. But let's go back to the S&P 500.
Sure.
The last time you were on the show was, I think, early September. It was right after that, pretty impressive bear market rally that we saw over the summer. And you said you wanted to be short the S&P 500 as long as we were below what you called the Mendoza line, which was that 4,200 level. And, here we are 6 months later, and it's still proving to be resistance. We tried to get above it in early February. The bulls couldn't do it. And here we are, as of Friday, we've pretty much given back all of the S&P 500's year-to-date gains, right? ending on multi-month lows like that. So is the Mendoza line, that 4,200 level, is that still your upside kind of line in the sand? Like, would that get you bullish if we ever were able to reclaim it?
So I'll give you the background on the Mendoza line. There was what they used to call a banjo hitting infielder in the major leagues in the 70s, and his name was Mario Mendoza. And he flirted for his career with hitting 200, which of course is 2 safe hits out of 10 at bats. And if you were above 200, you were above the Mendoza line. And if you were below 200, you were below the Mendoza line. You were in danger of being released or, of course, sent down to the minors. So that's why I thought 4,200 was the Mendoza line. Above it, the market was kind of doing okay, but below it, there were real challenges. And you can see what I labeled E2 was certainly not easy because it slightly got above E, but it didn't get above 4,200. So that's number one. Number two is I've always felt that it's been hard for me to really have much success with items that are still burdened by downward sloping 200-day moving averages. And despite the fact that E2 got through the 200-day, then it was still burdened by the slope of that 200-day moving average. So I thought that was a little bit curious. And number three is I really think that the message provided by breadth or the S&P equal weighted was quite informative, but it was not providing the message that most people were interpreting. For example, so here's breadth. Thanks, Patrick.
Yeah.
So breadth in February got right up to the August highs. It was a tremendous move. The first part from October through December was led by what I call non-growth, which was basics, energy, industrials, and financials. And then the second part from late December, early January through February was led by the former leaders, what the talking heads may have said or described it as same as it ever was, same as it ever was. And when the second part happened, I really felt that this was not a transition to a new bull phase. I'm of the school that when a bear market is complete or when the lows are in, that there is a transition to new leadership. And it was tech and growth that led the last time into the peak. And so I didn't think that's where the leadership would be. But son of a gun, that's what led us into February. We heard, the business heard, and the business was fairly apoplectic about how well the equal weighted S&P 500 was doing. And so I always ask questions about these things. My question is, nobody manages an equal weighted portfolio.
That's a great
Number
point.
one. And I thought comparing the S&P equal weighted and the S&P's breadth, which I'm sure you'll show shortly, to the Dow from 66 through 1982 was a pretty good comparison. So I'm going to probably be long-winded, but here goes. From 66 through 82, the chart just before this, the Dow went sideways for 16 years. There were 4 bears and 4 bulls. It's right in the middle. You could see it there. Maybe I shouldn't have used green font, but anyway, the top of the range was 1,000. After every cyclical bear within what was a secular long-term sideways trend, the market rallied right back up to the old highs. It got right to 1,000 every single time. And then it got the Hakeem Olajuwon treatment and got blocked. Its shot was blocked and it could not convert. And then, of course, it came back down to have a cyclical bear. Now, I thought this was appropriate because if you get to the next chart, thank you, Patrick, you'll see the S&P equal weighted in blue and the S&P breadth in black. Oddly, the S&P breadth in August made a new all-time high, but that was quickly reversed. And then in February, we got right to the breadth highs, and that's been quickly reversed. And then the S&P equal weighted got to within 8% of its high in its August rally, and then it got to within 6% of its high this time. And I thought that this is representative of what we saw, or what whoever was trading it saw from 66 through 82, in that these cyclical rallies got you to the top or virtually to the top of the range or the prior highs. But the S&P proper couldn't get there because of the excessive weighting for technology stocks. Now, I've changed the weightings in the S&P because the S&P tells you that tech is about 25% of the S&P. That's not true.
Right.
Tech,
of course, like, we're going to call
it's
Amazon
ridiculous, right?
not a tech stock, right? Yeah.
Right. Tech
Google
at its peak
yeah.
was more than 40% of the S&P. And so with tech being so big and weighing so much, and stocks like Apple, Amazon, Google, Tesla, Facebook, Netflix, still far from their former highs, there's no way the S&P proper was going to get back to the or near the old highs. But S&P breadth, which of course is equal weighted, and the S&P equal weighted got pretty darn close to the old highs. And I thought that was all we were going to get in this rally. So that's how I kind of put the puzzle together to compare the action this time to what we saw from 66 through 82, and thought that the S&P itself was not telling the real tale, because we already got what we were supposed to get, which was a 20% rally. Not what we were supposed to get, but what was all we were going to get in this period. It's a cyclical bull within an otherwise structural bear. So to expect more than 20%, and if you got it all, then kudos to you. But right now, the S&P is below the average price from June forward. And unless you bought the lows both times in October and then again in December, January, I have to figure for the last 8 months, most people are pretty much having a tough time.
Yeah, and I really like that point you make about equal weight. First of all, nobody really owns an equal weight portfolio, or at least if they're owning the S&P 500. Second of all, I haven't ever really been able to make much sense of the whole equal weight thing, because if equal weight is outperforming, that means the big boys aren't participating or aren't
or they're just as good as the small guys.
Right, exactly. So is that really a sign of health? I don't know. And another point, I really like the point you made about new leaders. That's something actually Walter Deemer, a point he made on the show, that new bull markets tend to feature new leaders. And of course, you did see materials and industrials really lead off the October lows. And I know you've been watching some of the areas within that. But I want to reiterate that another point you made, which is that we could be in for a multi-year period of just sideways, just kind of frustrating digestion period. That's been a big part of your thesis. Is that right?
It has been, mostly because this period here is attended by high inflation, like we saw from the 70s into the 80s. And please remember, it took 20 years for the Fed at that point to get the inflation genie back in the bottle. So let's hope that they have better luck this time. And number two is rates are higher, not as high as they were then, but certainly higher off of what were the GFC lows. And so I thought that that would kind of be a difficult situation as well. So those two implications suggest to me that we're likely to have some difficulty. And at best, I think we are sideways, but it's going to be difficult. I really think this situation is going to continue, or this kind of challenging environment, to put it politely, is going to continue.
Yeah, and outside of Chartis, it almost seems like people don't think that those periods can exist. There's so much talk about bull market, bear market, but what about these periods where we just kind of go nowhere, and you have a lot of big moves within it, but if you're just someone who's buy and hold, it can be a really frustrating environment. But you touched on rates briefly, and I want to delve a little further, because back to the banks, a lot of the bank weakness and all the things we saw with Silicon Valley Bank and all that this week, that's all tied to higher rates. And rates pulled back a little bit this week. We saw a pretty sharp move down in the 2-year yield, but I want to go to this chart we have of the 10-year yield. And you first shared this chart back in Washington, D.C. about a year ago at the CMT symposium. And you quoted your colleague Robert Soros saying, "The bond market never lies." And you've been saying that, every time we've seen a spike in rates to this magnitude, something tends to break, right? So we've definitely seen a few things break, right? Between FTX a few months ago and Silicon Valley Bank this week, they kind of resemble something breaking. So I got to ask, John, has the Fed broken something yet? And do you think we could potentially see more of these breaks or blow-ups?
Okay. So first off, I'd like to say that both Robert Soros and I was at Soros Fund Management for 4 years. Robert Soros and the 10-year Treasury yield are the undefeated heavyweight champions of indicators. Rocky Marciano was the only guy to retire undefeated. as heavyweight champ. And so this is the champ, the once and future champ. And every time the rate has risen, you could see that little box to the right, the numbers in the chart. There's been a big break. There has been a break this time, but I don't know if what we've seen break is enough. Clearly, and I'm not wishing this because I know the business is built up. We all do better when the market rallies, and certainly our own means of employment is at least more secure when the market does better and the economy does better. But I would suggest that there's probably some more pain to be felt. Silicon Valley is kind of the latest instance. I don't know how much that will escalate or snowball into some other issues, but certainly the Fed is breaking something. They always end up breaking something because they're always late. They're always late. It's very tough to figure out what's going on the ground when you ride in the back seat of a Federal Reserve driven town car. You don't pump your own gas. You don't shop for your own groceries. And Mary Daly of the San Francisco Fed said months ago, she doesn't feel the effects of inflation anymore. Americans have enough.
I wonder why.
Yeah, if that's the leadership amongst the Fed people, then perhaps this difficult period continues.
What happened this week with Silicon Valley Bank? That was directly tied to rates. The FTX thing, I think it was tied to rates, but it's a little less direct, right? Maybe there was some fraud going on there. Who knows? But what we saw this week with Silicon Valley Bank, that really seemed like it was a direct tie to that sharp move higher in rates, right?
I agree with you.
So, what do you think as far as the 10-year here? Do you think it's due for a pause or maybe a pullback here?
I do. I actually want to buy the TLT.
Really?
Yeah, I really do want to buy the TLT. I think that we've seen enough in terms of the rate move and the reversal, which is certainly important. And please know that the rate moving up to its recent highs did that without confirmation from weekly momentum indicators. And you could see it if we find that chart. It did it without the benefit of momentum kind of agreeing or confirming. So I do think that the rates are going to work lower here. I do want to try long the TLT. And if the Fed really has broken something, then I think you do want to be long bonds. Because if they've broken it, as I think they might have, then the economy is likely to slow, and you probably do want to own some bonds and some gold as well.
Yeah, and I keep hearing about a Fed pivot and all that, and I'm wondering what you think of when you hear that. It seems like that's kind of one piece of a potential bull case, right? Is if the Fed pivots, that should be a good thing, right? So I'm wondering if you have any thoughts on that.
Yeah, I think those thoughts are wrong because that's not what the history shows. And I think it's the next chart, Pat. Yeah, maybe one more or two more. I can't remember. Anyway, yeah, there you go. Thank you. So everybody believes, it is consensus that if the Fed changes from a rate hiking cycle to a rate cutting cycle, that we're in an all clear. Well, unfortunately, we're not. The history shows that when the Fed moves from a rate hiking cycle to a rate cutting cycle, that is the confirmation that the economy is going into a recession. And the S&P since the mid-70s, after the Fed has cut rates, has declined 41, 17, 20, 38, 53. It was up 8 and then fell 20% in COVID. So the numbers and the history don't suggest that we would be in an all clear if the Fed cuts rates, because it doesn't take into account all the damage that was done during the rate rising cycle. And I would just like to add, and maybe I say this because I have a lot of gray hair, but I don't know that there's ever been a period in Wall Street where so little of the market's history is understood. There seems to be, this is kind of like the old cartoon where a guy whispers into somebody's ear and then it goes through the whole cartoon. And then by the time you get to the other side, it was entirely different from the first message.
Like that game Telephone. Yeah.
Telephone. Right. Yeah. So I think that's kind of what it is. And on Wall Street, you kind of get credit for being first, not necessarily being right. And so I think it's going to be wrong that the market will get it all clear. So I think it's like Michael Crichton said here. I'm very fond of this quote. If you don't know history, then you don't know anything. You're a leaf that doesn't know it is part of a tree. And I think it's important to know what's transpired before. And that's what charts are so great at. When somebody says something, I always end up checking the chart immediately. The chart is kind of the crystal ball, not to tell you, what is likely to happen, but to look back in history and say, either what that person told you is right, or they have no grounding in telling you that because it's wrong. And so I think it's important to know that when the Fed is cut, going back to the 70s, the S&P has actually suffered, not benefited initially.
Yeah, I mean, I think that's such an important point, because it does seem like consensus. And again, people are looking at it like a bullish, development if we do get that Fed pivot. But what you have here shows that it's not necessarily something bullish should be hoping for. But we did see the 2-year get back below the Fed funds rate this week. Is that correct? I mean,
that's right.
Like I said, we saw that pretty historic, if you will, call it, move in the 2-year yield. So talk about the significance of that, if you could.
So since the late 80s, the Fed fund rate hiking cycle has ended when the 2-year has fallen below and through the Fed funds rate. Now, it did it late last year briefly, and then it accelerated, the 2-year accelerated through the Fed funds, let's say in the first 2 months here, and now it is back below it. So it would suggest to me that the Fed is either right near or pretty darn close to stopping their rate hiking cycle because, and let's be blunt about it, because Jeff Gundlach said it some time ago, and he's certainly better on bonds than I am, that the Fed follows the 2-year, period. 450 PhDs have to follow something, so they might as well follow the 2-year.
Yeah. And, I know you look at global yields too. So, are you seeing anything there that kind of confirms, maybe a pullback in rates here in the U.S.?
Yeah. So that's I think a pretty good point. Global yields, at least for industrialized countries, tend to move together. This here is the 3-month yields through the 30-year here in the U.S. And you could see all the way to the right that they've all kind of sharply moved lower. But there's another chart here that shows 10-year yields for Europe. That's 2-year yields global, 2-year yields for the English-speaking countries. And here's the European 10-year yields. All are correcting. You could see them all in the right-hand part of the chart, curve lower or correct lower, pull lower. So I think it's right to be long European bond prices here as well. Again, G7 yields move in a homogeneous fashion. And I realize maybe we could leave Japan out a little bit because they still operate under yield curve control, and maybe that's going to be ending here. But generally, they move in the same direction. So I figure there's going to be a correction in long yields in the U.S. There'll be a correction in European or G7 yields as well.
So I want to get your thoughts on the dollar real quick. I think your initial target was around 120. It fell a little short, but it got fairly close. And, we had that massive decline, and then we reclaimed the former highs, around that 103 level. And, above those former highs, it looks a little dicey, right? And you're seeing that kind of pressure on risk assets. So I'm wondering what your thoughts are on the dollar index here. Do you think it could potentially, make another go towards 120 or towards, those September highs, or was what we've seen kind of just mean reversion?
I don't think we're going to get back to the September highs.
Okay. I
don't think, and I want to sell it. And I'd rather sell it here. And if it gets up to 107 or 108, I'll sell it there. So I'd rather look at longer term stuff than shorter term stuff because I don't think I'm a trader. I think I'm a trender. And a monthly MACD has rolled, and I like to use a 12-month rate of change on the DXY contract. And the 12-month rate of change has been pretty darn good going back 40 years or so. And that's correcting. It's nowhere near oversold. So I want to try that. And if risk off is going to occur, then I'd rather be long yen versus dollar. And if the dollar is going to weaken, then it kind of fits with another thing that I've been going with where I would rather be long non-US equities relative to US equities. And I've shown that using market cap, the market cap for the U.S. as a percentage of world market cap, and I've shown it using price. So thank you for taking that softball and hitting it out of the park right here, showing the chart really quickly. So this is U.S. market cap as a percentage of world market cap. I still think there's a peak here, lowest level since August of 2021. And I think this is going to work lower. So I think U.S. market cap is going to deteriorate as a percentage of the world market cap, and then turned into price, which is the next chart. You can see that the S&P relative to the world, X the U.S. on a monthly basis, this would be the third big peak, big secular peak for the dollar, S&P relative to the world. Now, I know this is not admissible in stats class, but it is admissible in portfolio management class. And the first time it occurred was at the peak for the Nifty 50. And then there were cyclical rallies where the dollar reclaimed leadership, but the trend was lower into what was the early 90s. And then the tech bubble occurred. It took a little while after that because the dollar was really the last tech stock standing at that time, and the S&P was still outperforming. But then when it gave it up for a number of years. And I think this is the position we're in. You could see that there's a 25-month moving average. I like to look at this on a long-term moving average basis, and that's kind of cresting, albeit slowly. And then the rate of change at the bottom is clearly not oversold yet. So there are a number of inputs that suggest that the U.S. should underperform rest of world equities.
Yeah, and this chart is something you've been sharing since the beginning of the year, and that whole theme of, we could see U.S. underperform the rest of the world. And, we kind of have seen that move play out so far. And, in a lot of ways, John, it kind of reminds me of growth versus value for some reason, because, it just seems like you had that multi-year trend in place where growth outperformed value for over a decade, very similar to, US outperforming ex-US. And if that trend does change, one would have to think that it's probably going to be a process, right? And it's like a cruise ship turning, right? Where,
that's right.
At first people are very skeptical of it, and then after a while it gets harder to ignore, and then, you get that kind of performance chasing, right?
I think it's very difficult for investors who've made boatloads of money being long big cap tech for a long time to change their opinion that they have to sell these stocks, which I think will be sources of funds to fund other investments. I think it's going to be very difficult to change their mind. It won't occur, in my estimation, for years. There's no way it has occurred, and I don't think it will occur for years. It's kind of like sea changes, historical sea changes. It took a long time. And can I give you one anecdote?
Sure, absolutely.
Okay, so I spent a long time working at what was then called Arnhold and Espley Schroeder, and John Arnhold ran the firm. I thought working for him was terrific. And then the Arnholds bought the old SocGen mutual funds, which were run by a gentleman who was named Jean-Marie Eviard. He was also a terrific guy. And I used to go into his office and speak to him often. And he was a Buffett disciple, a real value guy. This was when gold was still in a bear market, so before the turn in 2001. And I started to get interested in gold, mostly because it looked like it was turning on my work. But every time I made a phone call on it, nobody was interested in buying it. So I said, well, my goodness, you got the charts that are trying to turn here, but the sentiment is really bearish. And I would go in to see him, and couldn't figure out why he was bearish on gold, and I was bullish on it. And it took me a little while to figure out, well, how could he possibly be bullish on gold? He had run a gold fund for 8 years, and all gold did was go down. And at the same time, I was writing a column for TheStreet.com. And at the end of my column, I would ask a trivia question. And sometimes I would give out the book, The Power of Gold by Peter Bernstein, as the prize for answering my trivia question. And so I asked Jean-Marie Eviard about Peter Bernstein, and he said Peter Bernstein used to send a newsletter out, and Peter Bernstein had a very storied career, worked at the Fed, wrote a number of books, Against the Gods, which is the story of risk. He was really well respected, and Jean-Marie Eviard used to pay for his newsletter. So he handed me a copy of his newsletter, and he said, John, why don't you call Peter Bernstein? He'll talk to you about gold. So I called Peter Bernstein under the idea that I would invite him to lunch. So I rang his house up, and his wife answered the phone, and I introduced myself, and I told her who my colleague was, Jean-Marie Eviard, and I'd like to invite Mr. Bernstein for lunch. She said, well, John, that's a highly unusual request. Let me see if Mr. Bernstein is available. So she put the phone down on the desk, didn't put it on hold, just I heard it hit the desk, and I heard her kind of clip-clop across the tile or linoleum floor. And then she clip-clopped back and she picked up the phone. She said, John, Mr. Bernstein would be glad to meet you for lunch. But I must tell you, I always accompany Mr. Bernstein on all of his lunches. I said, fine with me, Mrs. Bernstein, please come along. So I made a reservation at a restaurant called Oriole, which was on 61st, right off of Madison. And I went with a colleague of mine. And we were wearing suits, and a town car pulled up, and Peter Bernstein got out, and he was wearing a fedora, an overcoat. And Mrs. Bernstein got out, and she was wearing a little pillbox hat. She had a small handbag and white gloves. I thought it was like 1968.
When was this actually?
So this was kind of 02, maybe 03, somewhere in there.
Okay.
So gold had turned at around $280 in 01, and I got really lucky in October of 01 when I wrote a note to clients entitled Totally and Unequivocally Bullish, and it was about gold. And so we're at lunch, and I introduced myself, I introduced my colleague, and we sit down, and I said, Mr. Bernstein, I got to tell you, I really love reading The Power of Gold. It read like a novel, not like an academic treatise. Can you tell me why you wrote it? And he said, sure, John, I wrote it because I hate gold. I said, I don't understand, Mr. Bernstein. He said, you were a student of statistics, weren't you? I said, I probably should have done better, but go ahead. And he said, okay, John, I'm going to come to your apartment tomorrow morning. I'm going to ring your doorbell, and I'm going to say, come on down. We're going to walk this fair city all day long. You bring a light jacket with you. We decide to take a walk. So you come downstairs. He said, when I see you, I say to you, John, we're going to take this walk all day. There's a 5% chance that you get hit by a car. He says, what does that tell you statistically? I said, 95% chance I don't. He said, that's correct. He said, however, the ramifications of you being hit by that car are so grave and dangerous to you and your family, you must have insurance. That is gold to your portfolio.
Wow. I like that analogy.
That was the story he told. That was the story Jean-Marie Eviard believed. That was the story Jim Grant believed at the time, because I went to hear him speak too. That was kind of what John Hathaway believed. I went to hear him speak too, and he ran the de Tocqueville Gold Funds. And I used to have lunch and dinner with Richard Scott Ram, who was the chief strategist at the time at the World Gold Council when they were putting out the gold ETF, GLD. Nobody thought gold could go up on an absolute basis. They all thought it would hold its value on a relative basis, because at that time, of course, stocks were so egregiously expensive on a PE basis. So sometimes you come into those situations where you have the benefit of the chart turning and even the gold bulls not being bullish. When you find a situation like that, then I think it's time to really get long, but I don't know if that's appropriate here for gold, primarily because there are so few people still around in the business who have ever made real money being long gold.
As you said, it's kind of this base on base, kind of like a cup and
it's
handle.
Trying. Listen, I am biased to be positive here because the long-term trend is still good, or still intact, I think. And we might have this big kind of cup and handle or this big kind of rounded base and a breakout. And, I don't want to get hyperbolic with respect to potential price targets. Let's just say that there's pretty good potential here on a breakout, but there's still a lot of work to be done.
No, I hear you. It's been hard to love, but it's also been kind of hard to hate that technical setup.
Right.
Well, John, we could sit here and rip through charts all day, but we got to wrap it up. So thank you so much for coming on and sharing your perspective.
Thanks for having me, Patrick. Always a pleasure. Have a great weekend. And it's terrific to talk to you. Thanks for inviting me.
Yeah, we'll do it again soon. Cheers.
It's a deal. Thank you.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.